In this screencast, we will be looking at the valuation of accounts receivable. Now, accounts receivable is basically extending credit to customers when they're making a purchase. Most companies do extend credit. They don't request cash for every transaction the moment the transaction is made. Now, when you extend credit to customers, you run the risk that some of those customers simply are not going to pay what they owe you. Uncollectible accounts are a risk inherent in doing business. It's a normal part of doing business. But as accountants, we do need to take this into account. So the scenario we're going to look at is on December 31st, 2014, Brown Dog Delivery Company has $420,000 of net sales, and it estimates that 3% of those sales will be uncollectible. Of course, it doesn't know for sure how many of the sales will be uncollectible. It's always going to be an estimate what our bad debts expense will be. Now, Brown Dog Delivery also has $100,000 of accounts receivable at December 31st, 2014, and the allowance for doubtful accounts has a debit balance of $1,300 on December 31st, 2014. So I've put some T accounts down here and recorded the amounts. I recorded that we have a $100,000 debit balance in accounts receivable and a $1,300 debit balance in allowance for doubtful accounts and $420,000 worth of sales revenue. Now, this sales revenue and the accounts receivable, this is the cost. And accountants love to record everything at cost because cost is a reliable number. We know that that number is correct. However, we also know that some of our sales or some of our receivables are not going to be collectible. So while this number is a reliable number and it's a good number, it isn't always the most relevant number for people using financial statements because we know that we aren't going to collect all $100,000. So accountants try to balance relevance and reliability, and they also try to be conservative. We don't want to overestimate our accounts receivable or our sales amount. We know that some of that won't be collected. So that's why we do this estimate of bad debts expense and this allowance for doubtful accounts. We're trying to balance reliability with relevance, and we're also trying to keep our financial statements conservative. We don't want to overstate either our assets or our revenues. So the first problem that we are going to do is we're going to look at using the percentage of sales method. What is the adjusting journal entry for bad debts expense on December 31st, 2014? So we want to record the estimate that we have for bad debts expense, and using the percentage of sales method, we are going to try to concentrate on the income statement accounts. What we're doing with the percentage of sales method is we're trying to match the expense to the revenue. We want the balance in bad debts expense to reflect the percentage of sales that will not be collected. So what we do is first we're going to debit bad debts expense. When we increase an expense, we debit it. Bad debts expense is an operating expense. And then we are going to credit allowance for doubtful accounts. This is our contra asset account that we show on the balance sheet. Well, how much are we going to do this for? Well, we want our bad debts expense number, the balance in bad debts expense, to equal the percentage of sales that won't be collected. Well, we've got $420,000 of net sales, and we expect 3% to not be collectible. That would be $12,600. 3% of $420,000 is $12,600. So that is the amount, the balance that we would like in bad debts expense, $12,600. Now, because bad debts expense is an expense account and a temporary account, there is no balance in bad debts expense when we do this adjusting journal entry. Bad debts expense would have been closed at the end of the last period and it has a zero balance. So it's very simple. We want our bad debts expense to equal $12,600, and so we simply do an adjusting journal entry where we debit bad debts expense for $12,600 and we credit allowance for doubtful accounts for $12,600. And at this point, our balance in bad debts expense is $12,600. Now, if we were to look at the other method we can use for estimating our bad debts, the percentage of receivables method, we would come up with a different number. So I'm just going to delete this. And we'll look at percentage of receivables. So in percentage of receivables, we are not focusing so much on matching our expenses with our revenues. Instead, we're looking at the balance sheet and we're focusing on the cash realizable value of our accounts receivable, how much cash we actually think we are going to collect from all these accounts receivable. So this is a balance sheet emphasis. So in this scenario, if we estimate that 5% of accounts receivable will be uncollectible, using the percentage of receivables method, what is the adjusting journal entry? Well, we're going to use the same accounts. We are still going to debit bad debts expense because that is how we adjust our uncollectibles. And we are still going to credit our allowance for doubtful accounts. But now we need to look at this balance and allowance for doubtful accounts before we figure out this number. Well, actually what we can do is we can say our allowance for doubtful or our uncollectible accounts is the 100,000 times 5%. So 100,000 times 5% is going to be $5,000. This is how much of that $100,000 of accounts receivable we expect will not be collected. So this is the balance that we want in our allowance for doubtful accounts. We want to have a credit balance of $5,000 because that is the percentage of accounts receivable that we won't collect. Well, because allowance for doubtful accounts is a permanent account, that will probably have a balance, and indeed it does. So when we do our journal entry, we have to take that into account. We won't just do the percentage and come up with a number and do a journal entry with that. Instead, we need to take into account the balance we already have. In this case, we have a $1,300 debit balance. So if we take our $5,000 that we want and we add that $1,300 that's already there, we see that we need to do an adjusting journal entry for $6,300, which makes sense. We're going to credit allowance for doubtful accounts for $6,300. And if we net those, if we have credit of $6,300 and debit of $1,300, we have a credit balance of $5,000, which is the 5% of the accounts receivable. So there's just one extra step when we do that percentage of receivables method because we will probably have a balance in allowance for doubtful accounts.